Friedberg here, former portfolio manager and university investments instructor. I get this question so frequently. Do I need a financial advisor? And I'm not a financial advisor. And I'm not a financial advisor deliberately. I'm a former portfolio manager. I'm an investing expert. I've been investing for decades. But when someone comes to me and they say, do I need a financial advisor? I can give them non-biased advice that is a result of years and years and years of investing. So let me help you make your decision whether you need a financial advisor or not. So let's assume that you're earning some money. You're contributing to your 401k or your IRA, and you're just not confident about what to do with your money. You could pick a target date fund, which is a diversified mixture of stock and bond investments, and it's titrated in a way that it is riskier when you're younger with more stocks and fewer bonds, and poised to earn higher returns when you're younger, and becomes more conservative as you approach your retirement date. And we can stop right here if that's the type of investment you are in, because that will do it for you. But if you want to check out other options, let's see what you can do. Okay, so what does a financial advisor do? Number one, a financial advisor is someone who can hold your hand and educate you through market ups and downs. That can be really important if you get a lot of anxiety about investing. Then the basics. They can create a financial plan. They can manage your investments, including choosing the right asset allocation or mix of stocks and bonds for you. They can help you save and invest for college expenses or future expenses, devise strategies for a home down payment, plan for retirement, and even help manage your pension, your 401k, or invest for tax minimization. Sounds great. Now you may be thinking, why shouldn't I hire a financial advisor if they can do all of those things? Well, first of all, every financial advisor doesn't do everything. So let's get into whether you really need a financial advisor or not. First, understand that there are so many different types of financial advisors that there is a dizzying array of qualifications. And that's definitely very hard to figure out. Now, the three most common and well-regarded are a certified financial planner, financial consultant, wealth manager, financial coach, and even a robo-advisor might be considered a financial advisor. Each one of these has different certifications, different education, different backgrounds, and will charge differing amounts. I'm going to put a link below to the article so you can read more about it here. Now, here comes the question. We've talked about, should I use a financial or do it myself? And that's where things get tricky. Here's where we get into discussing the steps that it would take for you to DIY or create your own portfolio. Because let's face it, hiring a financial advisor in most cases will cost you. And typically they charge a percentage of the assets they manage or a special fee. And if you're cost conscious and relatively interested in investing do it yourself, it's perfectly acceptable to learn how to invest on your own. And I'll give you a hint. In most cases, you can do just fine with a very simple index fund portfolio. So let's give a quick overview on how to create a diversified index fund investment portfolio. Now, the advantage of doing this on your own is once your investment portfolio is completed, you've chosen the funds, you've chosen the percentages, it doesn't require much information or it doesn't require much attention. All you need to do is really annually rebalance it, update the prices, or if you want to use a service, which also happens to be free, called M1 Finance, they will actually rebalance your portfolio for you. I know it sounds crazy, and we'll put a link below to some videos that talk more about M1 Finance. So investing is for long-term goals. If you have something you want to pay for within the next 3 to 5 years, down payment on a house, some upcoming big bills, a vacation, don't put it in the investment markets. So where do I invest for long-term goals? Typically, you will invest in an IRA, a workplace account, or even in a regular brokerage account. Before you invest, you have to figure out what's my risk tolerance because investment markets go up and down. Stocks are more volatile than bonds. Here in this chart, you'll notice the long-term from 1928 to 2023 long-term annual returns of stocks as represented by the S&P 500, bonds as represented by a corporate bond index, and cash as represented by short-term treasury bills. And when we say volatile, we mean volatile. For example, you'll notice here, stocks went up this year over 40%. The next year, this is in 1928, obviously none of us were born then. Well, maybe you were. Next year, they went down 42%. But let's go on a little more recently. Let's go from, say, I don't know, 1994. Stocks went up 38%, and they were positive during the next couple of years. But then you go down to the early 2000s, they dropped 20%. So you might be saying, why should I invest in stocks? Because over the long term, investors have received the highest returns from stocks. So from 1928 through 2023, you'll have earned approximately 10% per year if you were invested in a diversified portfolio of stocks like the S&P 500. Invested from 1974 to 2023, 11%. So yeah, some years are going to be pretty rough. Think 1973 down 25%. Think 2007, 2008 down nearly 40%. But if you stay the course and continue investing in stocks, it's likely you're going to get pretty good returns. So we were talking about asset allocation, but I had to tell you a little bit about the differences between stocks and bonds. And so most investors hold some stocks in their portfolio and some bonds. And the reason for that is because they don't typically move in the same direction. And you'll see that here. For example, this period, early 2000, stocks fell, bonds rose. So if you had some bonds and stocks in your portfolio, you would have earned a more moderate return. If you were all stocks, pretty dire in this period with the over 20% loss. And that's one of the big reasons that investors, investment professionals recommend diversifying your portfolio. And that's where you see bonds on average have delivered a little bit moderated returns, 2014 to 2023, just about 4%, and 74 to 2023, about 8%. And then many people like to have a little cash, and that's, again, very stable value. Cash values don't go up and down. You hold those, you're going to keep a steady $1 value, but they're not going to grow much. 1% here, 4% from 74 to 2003. I like to use this long-term chart of 28 to 2003 at about 3%. That's about what you can expect on a return from your cash. So let's get back to asset classes. We looked at the last chart at stock and bond asset classes. And it's very clear, like we talked about at the beginning, that if you have a long time to invest and your portfolio can withstand losses when the stock market makes a big drop and you can stay invested, you're likely to gain a higher return from your stock investments than your bonds. And that's why younger investors typically hold a greater percentage of stocks in their portfolio than older investors who really need to keep more of a stable portfolio because they don't have time to make up the losses that come from great stock market declines. So back to creating your own portfolio. You determine your risk tolerance, and that'll determine how much percent of your overall investments you'll have invested in stocks versus bonds. Okay, how many asset classes should I invest in? people can get really granular with large cap, small cap, value, growth, all different types of stock funds. But you can get a perfectly diversified investment portfolio with literally 2 funds. Lazy portfolio does not mean bad portfolio. It means that you don't have to get fancy to participate in the investment markets. Here are 2 lazy portfolios that are so easy to manage and will deliver very good long-term market matching portfolios. And in the last segment, you saw matching the market is pretty good. And as an aside, most actively managed mutual funds, that means a manager is trying to buy and sell the assets, the investments within the fund, typically do not outperform a lazy index fund portfolio. So keep that in mind here for you DIY investors. You can invest half your part of your money in an all-world stock market index fund or ETF, exchange traded fund. This fund will cover a representation of stocks from the entire world. Is that diversified enough for you? I certainly think so. And then on the fixed income side, one fund that covers the total US bond market. Now, if you want to go international, you can get an international bond fund too, or a total world bond fund. Laziest portfolio ever, super easy, very diversified, because each of these funds, and I'll put the tickers down below if you want to just plug in these funds and invest in them on your own. Each of these funds owns thousands and thousands of investments. Now, let's say you want to get a little fancier and still be on the lazy side. We've got this. Bernstein is a very well-known investment expert, and he crafted a portfolio with a European stock index, a small cap stock index, and a Vanguard S&P 500 index, and then the total bond market index fund. A little more diversified, but still lazy. That's it for DIY investing if you want to make it super easy. Now, we can get a lot more complex, but that doesn't guarantee you'll get better returns. So the question remains, should I use a financial advisor or should I do it myself? We've gone over the things that a financial advisor can do for you. We've talked about how easy it is to set up a DIY portfolio. I even put a plug-in for a company that I'm in partnership with, M1 Finance. And as an aside, if you do sign up to use M1 Finance, on the link below, our company might get a small commission. They'll rebalance your portfolio for you for free, making DIY investing very, very easy. So, my personal bias is most people who have a modicum of interest can read a book or two, learn about index fund investing and asset allocation, and very successfully manage their own portfolio. They can buy a target date fund or even use a robo-advisor, which in most cases is either are very, very low cost. But if you have a more complex portfolio, if you really have some serious questions, if you need a lot of advice or information, then you probably should have a financial advisor. So before we wrap it up, choosing a financial advisor is not easy. You want to ask these types of questions to the people that you are screening. And we have partnered with WiserAdvisor, who will give you 3 financial advisors to interview in your area. And this service is free, although again, if you do click on this link, our company might get a small commission. They will help you get started with your financial advisory journey. So the type of questions you'll ask are, what are your certifications, credentials, qualifications? Do you have any complaints? And that's where you go to broker check. We've got a link here in the article because they'll tell you all the complaints. Super important. You want to know if your broker, your financial advisor, has had any run-ins with the SEC or other regulatory agencies. You can ask friends for referrals. Then you want to find out, what are your services? What can they and can't they do for you? This is a big one for me. What are your fees? That's super important, because any money that's going to be paid for a financial advisory service, and many of those services are well worth the fees, but realize that money is not going into the investment markets. So interview at least 3 advisors before choosing one. Now you have all the information you need to make an educated decision whether you need a financial advisor or you can DIY your own investing. Thank you so much for stopping by. I'm Barbara Friedberg. If you like this video, please give me a thumbs up and subscribe. If you have any questions, I love questions and comments and will be happy to answer them. Just leave them below. See you next time.